What's up, Facebook? Ty Crandall here with Credit Suite. Really glad you could join us today. So today we're going to be talking about business credit scores. Most importantly, we're going to be talking about everything you need to know to control your business credit scores to help you become more lendable. Look, whether you know it or not, lenders and credit issuers look at your business credit scores to determine if you should get approved for financing, how much money you should get approved for, and they also use it to determine the rates and terms that you should pay on the financing you get. So if you're an entrepreneur even thinking about getting a loan, a credit line, or a credit card, then what you're going to learn about today is really important because it's going to control whether you get approved, the rates and terms you'll pay, and how much you're actually going to get approved for. So today we are diving in and we are going to decode business credit scores. We're going to talk about how you can easily control these to make sure that you have the best chance of getting the best terms when it comes to financing. So we're going to be diving in talking about Dun & Bradstreet. We're going to be talking about Equifax. We're going to be talking about Experian. And then we're also going to be talking about your FICO SBSS score, which is what's used by SBA. We're going to talk about where to get these scores. We're going to talk about how to control these scores. Again, everything you need to know to build your score strong enough to where it makes it easy for you to be able to get the financing you need to grow your business. So let's head to the chalkboard. Let me see, get my hand out of the way. Okay, let me see if I'm still trying to control the flash here, but it's a little dark. We'll figure it out. So the business credit reporting agencies have different types of scores you should know about. There's a few main ones you probably should know are important. First of all, you have performance versus predictive scores. So when you pull a business credit report, it's very common for you to see 5, maybe even more scores on your credit report. In the business world, you have 2 main kinds of scores. You have what are called predictive scores, which predict your likelihood of default in the future. And you also have what is called performance scores, which are completely and strictly based on how you've performed in the past, only based on how you've paid your past experiences. So you need to know the difference between these two because payments or performance scores are actually just estimates of how you may perform. But when it comes to actually performance scores are based on how you performed in the past. So you can directly control those just by paying your bills as agreed. When it actually comes to predictive scores, how you've paid your bills will tie into how those work as well. Okay, another main kind of score is called the financial risk score. Now what this score literally depicts is your likelihood of going bankrupt over the next 12 months. So anytime you see anything about financial risk or financial stability, what that score actually means is it means your real risk of going out of business in the next 12 months. That's literally what that score depicts. And the third score here is called the percentile score. Percentile score means how you rank against other people in your industry. It's based on a percent. So percentile score, anytime you see a score with the word percent or percentile in it, it means how you rate against other people in your industry. So why is this important? Because look, you may be considered to be high risk because you're in a high risk industry. As a matter of fact, when we look at Experian, about 5 to 10% of Experian's score has to do with the size, with the industry that you're in. If they don't like your SIC code, it can hurt your score. But with percentile scores, you're being ranked against everybody else in your industry to see how you compare. So again, it gives you a fair analysis because they're not holding against you the industry that you may be in. Timothy, Steve, thanks for the thumbs up. So guys, this may be a little dark. My apology. I don't know if it's because my phone is low on battery or what it is, but we'll make it through. So Dun & Bradstreet, biggest reporting agency in the world, they have a paydex score. Some of the main things you need to know. First of all, you have to have at least 3 accounts reporting to them. That's what a payment experience is for them to even ever generate a paydex score. If you don't have 3 accounts, you'll never get a paydex score. So a lot of people ask, why isn't Dun & Bradstreet reporting my accounts? Well, probably because you don't have 3. If you have 3, they'll populate a report and they'll populate a paydex score for you. Now, there's 2 things you need to know. One, it's based on 1 to 0, with 100 being the highest score you have. It's called a weighted average score. So the way that this works is twofold. First of all, the paydex scores 0 or 1 to 100 based on how you pay. That means it's a performance score, right? It's based on your previous performance, how you've paid your bills in the past, okay? The better you pay your bills on time or early, the better the score gets. It's also what's called a percentile score, it's also what's called a weighted average. What weighted average means is it means they take the higher limit limit accounts that you have, and then what they do is they rate those higher into your score. So that means a 10,000 limit credit account will have more of an impact to your Paydex score than if you only have a limit of $1,000. Why does this matter? If you're ever going to have to go late with something that reports 1, the later you go, the worse damage it causes to your score. So try to get it paid as soon as possible. And 2, if you ever have to pick what you're going to go late on the lower limit accounts that you have. Those will have less of an overall impact to your total score. So it becomes very important. Michael says, I have my business registered under management. Would it be considered high risk? No, management is not considered high risk. Great question. So that's what you need to know about the Paydex score. 1 to 100, 100 being the best. Pay your bills as agreed and you'll get a good score, but you've got to have 3 accounts reporting for D&B to show you that payment score. D&B's financial stress score. Oh, we learned this, didn't we? We learned that financial risk means failure of filing bankruptcy. So the financial stress score is based on historical data, based on your past performance, your company, and your company size. Okay, 1001 to 1875 is the rank, with 1000 being the highest risk of business failure. So the higher the score, the better. And again, this is basically used to depict your risk of going late in the next 12 months. Now, again, with this, you also have a financial stress risk class. Again, still has to do with bankruptcy, potential of filing bankruptcy. This ranges from 0 to 5, with 1 being the most likely to fail. You have to know that these scores are primarily based on past payment performance, how you've performed in the past. And the problem is if they don't have much other previous past performance, then they'll use other things like financial data, number of employees you have to determine these type of things. So you need to make sure that you pay your bills on time, and that can also help you here with this financial stress score. And as we get down here to D&B's rating, I'll talk to you more about how your financials tie into all this as well. Okay, so the financial stress score percentile. Remember, we learned what percentile means, right? Percentile means how you rate in your industry. So the financial stress score is how you rate against all companies. Financial stress score percentile is how you rate against other people in your industry. Now, this score ranges from 1 to 100, 1 being bad, 100 being good, okay? So again, paying your bills, making sure that you have a lot of accounts reporting, a good mix of accounts, financial data being supplied to them, all those things can give you better ratings there. The D&B Supplier Evaluation Risk Rating, or what's called a SIR rating. So the SIR rating rates your likeliness to fail in the next 12 months if you're a supplier. Okay, it's based on the financial stress score percentile. We just talked about what that is. It's based on your time in business. It's based on your payment experiences, and it improves in time with the reporting agencies or with D&B. So here's what you need to know about the SIR rating. The SIR rating really matters to you if you're doing 2 things. 1, you are a supplier. You need to be concerned with what your SIR rating is, because your SIR rating is going to determine your risk of defaulting in the future. And people that do business with you are going to want to know that your SIR rating is good. Secondly, and again, I'm having on light issues. I think it's because my cell phone battery is pretty low. It might not even make it through this live stream. Secondly, if you're going to buy from a supplier, you probably want to know what their SIR rating is, because you don't want to give somebody $10,000, then they go bankrupt and you never get your supplies or your 10 grand. So if you're looking into a supplier, the SIR rating is what you need to know and look into to them. And again, if you are a supplier, you need to focus on getting your SIR rating as high as possible, because that's what tells other people how likely you are to actually deliver on the goods that you're supposed to deliver on. Okay, now, D&B's rating. Okay, so this has a classification of what's called 5A to HH, and it basically has to do with a few different things. Based on the worth or equity, the financial position of your company. If they don't have that, they're actually looking at the size of your business instead. And it can be improved by providing finance. Okay, so when you're saying it looks good on your end, that's good, because mine, it goes really dark when I do that. Here's what you need to know that's very interesting about your business credit scores. You control whether the reporting agencies have your financial data or not. Financial data, I mean your tax returns. If you supply your tax returns, they rate you differently because they have the information. If you don't supply your tax returns, here's where it gets scary. They base your financial worth based on the number of employees you have. So if you're a startup or have fewer employees, you can automatically consider to be high risk because they don't think that you're very big or very profitable. So you choose whether or not when you're supplying information, it goes to D&B. You give them your financial data. If not, if they don't have it, they'll put you into a category indicating they don't know your financial data. Then they default to looking at your employees or the size of your business to determine your financial worth. And if they don't have that, then they rate you saying that they don't know enough information to even give you a good rating. So this is where loans come into play. When people ask me, look, can you build your business credit just to get loans? The answer is no, because lenders are looking at percentile scores. They're looking at financial stress scores. They're looking at your D&B rating, which means they're looking at your revenue. They're looking at the likelihood of default or going bankrupt the next 12 months. They're looking at the scores that actually reflect the financial stability of your score per your tax returns. So if you don't have all those things in line, you're still going to struggle to go out there and get business loans. Michael says, I have a $10,000 line of credit with Sunbelt Rentals that I haven't used. It's my highest vendor credit. That's awesome, but make sure you use it. The using of that credit is what's going to continue to get you higher and higher limits. Remember, guys, what shows on business credit reports is the recent amount of credit you've used. So it's very important not just to get high limit accounts, but to use them so credit issuers can see that you're using that credit, which will also get you higher and higher approvals. So it's very important to consider. So that really wraps it up with Dun & Bradstreet. Paydex, based on payment performance. Financial stress score, your risk of going bankrupt over the next 12 months, okay? The financial stress risk class basically has to do with the class that you're in or the information that they do have access to. Okay, the financial stress score percentile, how you rank against other people in your industry. SIR rating, supplier evaluation, only matters if you're buying from a supplier. You want to see what this score is. If you are a supplier, you want to make that good to give people confidence that that your business is stable enough to get supplies from you. And your D&B rating, which takes into account your financial health or your tax returns or employee size. You can control this by making sure that you get financial data to the reporting agencies like D&B. Jerome, what's up? I never said hi to you when you came in. So, Equifax. Small business risk scores, the main score that Equifax offers. They are the smallest reporting agency in the commercial space. Guys, thank you for the loves. Thank you for the like. Thank you for the shares. Let's get other people in here and tell other people this information. And the more likes and loves and shares that you guys do, the more it helps us do that. This is also based on 1 to 100, with the 100 being the highest score. The small business risk score, the Paydex score, and down here, the Experian Intellis score all depict your risk of going 90 days late over the next 12 months. Okay, so you want to make sure that you pay your bills as need, because that's primarily what Intellis score is based on. Here, I'll show you the exact breakdown. Here's how Intellis score actually breaks down. 50 to 60% of the payment score, or the score, is based on payments and balances. The balances you have, the payments you made. 10 to 15% based on utilization. 10 to 15% based on derogatory items. 5 to 10% historical behavior. 5 to 10% of the score, age, industry, and size. Here's what you mainly need to know. If you look at what most of the score is, payments, derogatory items, historical behavior, you'll see that 85% of the score has to do with how you pay. So with D&B's Paydex score, it's 100% based on how you pay. Equifax, 100% based on how you pay. By that I mean, look, if you pay 14 days late on average, you get a 70 score, right? If you pay 90 days late on average, then you're getting a 50 score. Okay, so with Equifax, it's the same way. The score depicts how you pay. Intellis score, 85% of the score is how you pay. So what it comes down to is it really comes down to being able to understand that making your payments is the most important thing you can do with any of your scores with the reporting agencies, especially these performance scores. Now, C says, do you have all these live on YouTube? Yes, somewhat. We used to put our old Periscopes on YouTube. Then when we went solely to Facebook and stopped doing Periscope, we've started to put those on YouTube. So you are able to find them. We even have a playlist with our live streams that you can then access. Okay, so Experience and telescore, we already talked about how that works. It's based on payment history and current status and balances and utilization. We already talked about exactly how that breaks down to the percentage of each one. So again, 1 to 100 can show a blended rate. So what happens is there's many things you need to know. And I won't get into all the classes here, but what I will tell you about Experian is this. With Experian, they have a blended score that you should know about. The blended score with Experian blends your consumer and your commercial credit profiles and scores into one. Now, the good news is this isn't used a lot. The other good news is per the Fair Credit Reporting Act, if your consumer credit ever is used, they have to get your permission. So that means that you're never going to have to worry about a commercial lender just pulling consumer credit because they can't do it without your permission. And the blended score isn't used a lot because people don't want to get your permission to look at your business credit scores. They don't have to with any of the other scores because the Fair Credit Reporting Act doesn't apply. So there is a blended score, but you're not going to see it used very much, but you should at least know that it exists. Now, we jumped off Equifax and everybody got a chance to jump into it. Okay, so Equifax, small business risk score, 1 to 100, 100 being the highest score you can get strictly based on how you pay your bills. If you want to see how that score breaks down, right here it is, okay? 90 plus means you make payments as agreed. 80 to 89, 1 to 30 days late. 60 to 79 means you pay on average 31 to 60 days late. 40 to 59, 61 to 90 days late, blah, blah, blah. Bottom line is how late you pay determines how low the score goes. So if you pay on time or early, you get a good score. With Equifax, you get it with D&B and you get it with Experian. That's how that score actually breaks down. Now, they also have the small business credit risk score for financial services or suppliers. It's a little bit different. The score range changes. The concept's the same. 101 to 992 for financial services is the score range. 101 to 816 for suppliers. The higher the score, the better. Okay, it predicts your chances of going seriously delinquent or charging off. The business failure risk score, we see this again, right? This financial risk score, which means potential of going bankrupt. 1,000 to 1880. 1,500 means you have, I'm not even going to get into this, but what I will tell you is that based on the score is the percentage of likelihood that you will fail. So for example, if you're 1,000 to 1,247, that means you have about a 50% chance of failure. So the better, the higher the score you have, the better. Even a 1,500 score means you have about a 10% chance of failure. So the more you pay on time, the better that score is going to be. Based on your demographics, based on public record, derogatories, credit, payment history, etc., etc. And again, it can be improved by simply avoiding derogatory payments. Kevin, welcome, man. Haven't seen you for a bit. I'm glad you came in. Okay, so SBS score. FICO SBS says, why do you care? You don't, unless you're getting an SBA loan. Look, a lot of lenders are not using FICO SBSS. They're using Paydex. They're using Equifax, a small business risk score. They're using Experian and Telescore. But SBSS is used by SBA. If you ever want to get an SBA loan, you need to know this because this is what's used by SBA. And if you don't have a high enough score with FICO SBSS, you can't get an SBA loan. So Joyce says, I have one business credit card. I've one for about 3 to 5 years. I've been paying on time and I've never knew about business credit until I started listening to your video. That's awesome. So do I have a business credit or maybe they gave it to me on personal credit? Well, the only way you know is to look and see. If you go to creditsuite.com/monitoring, you can get monitoring for $24 with D&B and Experian to figure that out. You can also go to Dun & Brad, or you can go to creditsuite.com/reports, and at creditsuite.com/reports, you can do a free search with Dun & Bradstreet, Equifax, and Experian just to see if they know anything about you now. And also, don't forget to either go to our Facebook page or creditsuite.com/EIN to get a free guide on building business credit, Joyce. That way, you can actually build business credit that does report to the reporting agencies in case that doesn't. So FICO SBSS has an overview section, has decision scores, has collateral and details and financial data on it. All of these things are things you're going to find on the SBSS report. Now your score ranges from 0 to 300. 180 is considered to be good, excellent. 140 is good, but you don't have any business credit history or limited time in business. So here's how it works. SBA requires a 140 for you to get approved. So because SBA is at 140, most banks that offer SBA loans are about 160. That's their cutoff. And the reason they're that way is because they want to make sure that the loans they're putting in can actually get done per SBA. So you need to have about a 140 or 160 to have any chance of getting an SBA loan. Here's what's important. You can't get a 140 to a 160 without having some kind of established business credit. So you have to establish business credit to ever even basically qualify for an SBA loan. You can't get an SBA loan without business credit because of FICO SBSS. FICO SBSS won't give you a high enough score to get an SBA loan if you don't actually have enough business credit reporting to be able to do so. Now, Dennis says, how long does it take for a new LLC to get business credit cards or line? Go to either facebook.com/credit suite and type in the letters EIN into our messenger on our Facebook page, or go to creditsuite.com/Facebook. If you're following our guide, you can get vendor credit right away. Your business credit profile and score will be established in about 30 to 60 days, and you can get store credit in about 30 to 60 days, then get cash credit in about 4 months. So that answers hopefully that question. Okay, so a lot of information here. Business credit scores, the way that SBSS works, they're looking at your personal information and your business credit reports, both of them. They're both part of SBSS, but here's why it matters. If you have enough established business credit, then what will happen is FICO SBSS will pull the data mostly from your business credit reports and scores to give you a good score. If you have little to no business credit score history, they will pull the data from your personal credit reports to populate the score. So if you want your business credit reports and the quality of scores you built there to carry your weight, you need to build business credit. That will then take more of your FICO SBSS score. But if you don't build business credit, you'll never have a score high enough to get an SBA loan, and they'll pull and make up most of your score from your personal data. So lenders determine with FICO SBSS where the data comes from. They determine, I want Dun & Bradstreet's Paydex score brought in first. I want Intellis score from Experian brought in second. I want Equifax's score brought in third. And then I want personal data brought in last. That's usually the order that they take. But what happens if FICO SBSS got it, Captain? That's the order. Oh, they don't have a Paydex. Oh, they don't have an Experian Intellis score. Oh, they don't have an Equifax commercial score. Oh, here's their personal credit report. Now we're going to populate the whole report based on that. That's how it works. If you don't want it to work that way, you've got to build business credit to prevent that from happening. So, you want to know what your scores are? creditssuite.com/monitoring. Usually to get your Dun & Bradstreet and Experian reports, it's $200 a month. It's $50 with Experian, $150 with D&B. That's a quick link to get it for only $24 a month, and you can cancel anytime. Or you can also go to creditsuite.com/reports to see if you have anything reporting now. So I'm going to go ahead and wrap up because my phone's doing some crazy stuff. It has lower battery than it's ever had doing a live stream, and I think it's trying to conserve energy, so it's like blacking out my entire screen. So as we wrap up, remember, creditsuite.com/reports. You can do a free search to see if Experian, Equifax, and D&B even know you exist. Costs you nothing to do. creditsuite.com/monitoring. If you want credit monitoring, you get it for $24 a month through our nav integration with Experian and D&B without spending the $200 that they're going to charge you. Do you want a free guide on building business credit? Go to facebook.com/credit suite. On our messenger, just type in EIN. We'll get you a free guide that maps out business credit building, and we'll also notify you each week as we go live to teach you how your business credit scores work, how to get capital, everything along the way. If you want another shortcut, you can go to creditsuite.com/Facebook and get your guide there as well. So I'm going to wrap this up. I will be back here next Wednesday at 4 o'clock Eastern for another topic, and all this gets wiped out. So go say goodbye to the chalkboards. Goodbye, chalkboards. All that gets wiped out this weekend. We redo all the chalkboards, and we'll have 4 new topics to come in the weeks to come, all about helping you get capital, helping you get business credit, helping you understand how all the system that banks don't want you to understand works so you can master the system and get capital, which is important because I've personally seen the amazing things entrepreneurs do if you're empowered with the capital to do the things that you want to do. So follow us here. We're here typically every Wednesday at 4 o'clock unless I'm out of town. And if you want to get notified live, go to facebook.com/Credit Suite, type in EIN and Messenger, and we will then notify you every week that we go live. Is this topics in the guide? Yes, we do talk about business credit. We do talk about business credit scores a little, but not a lot. But mostly the guide maps out the exact steps to building business credit. So I'm going to wrap this up. Thanks everybody for tuning in. I will see you next Wednesday at 4 o'clock Eastern here live on Facebook. Thanks everybody. Have a great day.